Well, continuing the conversation here on Disney, Disney shares falling on those mixed Q2 results. So how should you consider making investment decisions after this report? Joining me now, we've got Geetha, Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Great to have you here with us, Geetha. First and foremost, just want to get your read in on this report and how investors seem to be reacting to this as we're seeing shares slip here out of the gate this morning as we're about 90 minutes into trade.
Yeah, thank you, Brad. So the fiscal 2Q results itself, I think, were pretty good. You know, there was obviously an earnings beat, as you pointed out. Streaming for the very first time in its history turned profitable, and that really kind of sets the stage for the future of this streaming business. It is going to churn out a lot in profits. You know, upwards of 1.5 billion probably in fiscal 2025. And ultimately, look at where Netflix is today. This year they are estimated to throw out about $10 billion in profit. And so, we kind of see the same path for Disney also. But I think what is really spooking investors today is their commentary on the parks business. So they, as Ali just pointed out, they did say that they are seeing this moderation in demand. And for the fiscal third quarter, their guidance was really, really choppy. They basically said, expect absolutely no growth in theme park operating income. Consensus had that at about 12%. So that's where you're seeing a lot of that nervousness kind of come in this morning.
At what point are we going to have to start seeing companies cut the prices here? I mean, for the theme park pricing, it's gotten really expensive. And even as you're thinking about taking an entire family there, that runs up the tab real quick when you're talking about concessions on top of that. And oh yeah, I got to get the merchandise because the kid wants the doll. So all of these things considered, how does that impact the pricing mechanisms that these companies are talking about?
It, for certain, Brad, I mean, it is going to lower their pricing power, right? It's a very, very tricky balancing act between, raising prices and balancing a good, strong, healthy, robust demand. Coming out after COVID, we saw almost a 40% increase in per capita spending across the parks. We saw huge profit numbers. We saw huge attendance numbers. Of course, we're going to see a big moderation in all of that. But you're absolutely right in terms of them. Their future strategy obviously has to be this very, very careful mix and this very careful kind of balancing act when it comes to taking pricing increases.
We talked about streaming as well here, and of course the milestone that they did see on that front here. Do you think that's sustainable?
It absolutely is sustainable. And for Disney, they have plenty of levers, right? They have this integration with Hulu that is coming up. Just yesterday, we got some news about them kind of pulling in a third-party arbitrator to determine the value there. And hopefully that should get resolved in the course of the next few months. And once that does get resolved, they basically pay the rest of the money to Comcast, and the asset is fully integrated. That should help them realize some good operating income synergies, especially when they kind of combine that with the Disney Plus business. They can take out a lot of extraneous costs. And then, of course, you have the advertising tier, right? Disney Plus just introduced advertising. They haven't necessarily broken out any numbers, but obviously as more and more eyeballs kind of keep shifting to streaming in general, connected TV advertising is really gaining steam, and we expect Disney Plus to benefit. And of course, the big one, as both you and Ali just pointed out, is that crackdown on password sharing. I mean, after Netflix, that's just been a home run for Netflix. So after they implemented that sometime last year, we know that Netflix gained around 35 million subscribers. So obviously it's a huge subscriber growth driver. It's a huge ARPU driver in the long run. And so we definitely think that Disney will benefit from that as well.
You mentioned Netflix, and somewhat of a long-winded question here, I guess, but of course Disney just coming off of that activist board seat battle here with Trump. And ultimately, they were able to retain that board seat. But that activist campaign actually put investors on notice for the type of margins that they should want to see Disney be able to achieve. And that comps them up to Netflix. So is Disney going to be able to get to that type of margin profile on the streaming business?
So what they have said right now, Brad, is they haven't actually given us an exact margin number. They have, though, guided to double-digit margins. Now, just for context here, Netflix this year will report 25% operating margin. And this has kind of been the perennial question, Brad, in media. If you kind of looked at the old cable TV business, that was about a 35% margin business. And as everybody kind of made this transition to streaming, the question was, are we ever going to be profitable? Of course, Netflix has kind of paved the way there. I think with Netflix itself, we'll kind of see them get to 35% margins. And with Disney too, I think obviously they're not going to get there as quickly as Netflix, but they obviously have set kind of that playbook. And I think Disney will get there too in due course. They do have a lot of operating leverage in their model as well.
Geetha Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Geetha, great to see you. Thanks so much for taking the time.